day, everyone. I am Jeissel, and I'm going to discuss about investment in debt securities. Debt securities are negotiable debt instruments, which means they can be bought or sold between two parties in the market. They come with a defined issue date, maturity date, coupon rate, and face value. Debt securities provide regular payments of interest and guaranteed repayment of principal. An example of instruments are bonds, which is a formal and conditional promise made under seal to pay a specified sum of money at a determinable future date and to make periodic interest payment at a stated rate until the principal sum is paid. So in a bond, an entity which we can call the issuer or debtor has to borrow a huge sum of money, which may be impossible to do in a bank. As a result, he can issue bonds which are bought by the public, multiple people, or an entity. These are called creditors, bondholders, or investors to be paid on a specified date. It also includes an underwriter or arranger who serves as a middleman in the transaction. There are three classifications of investment in debt securities, namely financial asset at fair value through profit or loss, financial asset at amortized cost, and financial asset at fair value through other comprehensive income. For this discussion, I will be discussing about financial asset at fair value through profit or loss and financial asset at amortized cost, and the subsequent topic will be discussed by the next reporter. So financial asset at fair value through profit or loss is a classification of financial asset that includes instruments which are held for trading or instruments that are bought with the intention to sell within a short period, or they are irrevocably designated at fair value through profit or loss, and all other investment in debt securities that do not satisfy the requirements for measurement at amortized cost and at fair value through other comprehensive income. For its presentation in the financial statements, it is presented as a part of the current assets in the entity's statement of financial position. It is initially measured at fair value and transaction costs included are expensed outright. To further understand this topic, let us look at some illustration problems related to this topic. So illustration 1. On January 1, 2021, Aurora Company purchased 1 million bonds at 98. The bonds mature on January 1, 2025 and pay annual 12% interest beginning January 1, 2022. Commission paid on the acquisition amounted to 50,000. The objective of Aurora's business model is to sell such bonds in the near term to take advantage of fluctuations in fair value for short-term profit taking. Accordingly, the bonds were classified as held for trading securities. So, as per requirement, prepare the journal entry on the acquisition. For this illustration, the face value is 1 million, with an annual interest of 12% and a transaction cost of 50,000. As per requirement, let us prepare the journal entry on the acquisition. First, we will compute for the fair value of the bond, which will be 1 million, the face value multiplied by the quoted percentage of 98. So this 980 will be debited as investment in bonds. And then let us add any transaction cost. Then we will debit brokers and commission expense for 50,000. And then credit cash for the acquisition, which is 1,030,000. Now that we're done with this initial measurement, let us now compute for the subsequent measurement. So subsequently, it is measured at fair value with changes in fair value included in profit or loss. Let us solve this illustration to understand this topic. On January 1, 2021, Aurora Company purchased 1 million bonds at 98. So this is the same problem as before, but it is said here that on December 31, 2021, the bonds are quoted at 102 rather than 98. So compute for the unrealized gain or loss and prepare the journal entry. To solve for the unrealized gain or loss, let us first compute for the bond's fair value. For this, we will just simply multiply the face value of 1,000 with the quoted price for the year 2021. That is 102 or 1.2%, and we will get 1,020,000. then less the bond's carrying value, which is 980,000, then we will get the unrealized gain of 40,000 since the fair value is greater than the carrying amount. The journal entry to record the increase in fair value is investment in bonds at 40,000 and credit unrealized gain at 40,000. The financial statement presentation for 2021 in the Statement of Financial Position is investment in bonds at 1,020,000 and for the Statement of Comprehensive Income, unrealized gain for 40,000. Now let us move on to the computation of interest income. For this, we will just simply use the nominal or stated interest rate earned during the period. And for this same illustration, the nominal rate would be 12%, which is then multiplied by 1,000 and we will get 120,000. To record the accrual of interest, we will just simply credit interest receivable of 120,000 and the interest income that we have just computed. For each subsequent collection, we will debit cash at 120,000 and interest receivable of 120,000 since the collection will be for the year 2022. Next is the recognition for financial asset through profit or loss. Realized gain or losses on the recognition of fair value through profit or loss is recognized in the profit or loss. The gain or loss is computed as the difference between the net selling price and its carrying amount or the fair value of the previous measurement date. Now let us look at these illustrations further explain how the recognition works. So again, it is the same problem as before, but it is said here that on January 6, 2022, the bonds were sold at 105. So first, let us compute for the amount of gain or loss on the sale of investment. The selling price of the bond will be computed using the quoted price, which is 105 or 1.5%, multiplied by the face value of 1 million, then the selling price is 1,500,000, less the carrying value of 1,020,000, 1,020,000 that is the fair value of the previous measurement date. The difference is the gain on recognition that is 30,000. So the journal entry to record the sale on January 6, 2022 will be as follows. So debit cash 1,050,000 and credit financial asset for 1,020,000 and gain on sale for 30,000. And that is all for the financial asset at fair value through profit or loss. Now let's move on to financial assets at amortized cost. Investment in debt securities are classified as financial asset at amortized cost when both of these conditions are met. First, the business model is to hold the financial assets in order to collect contractual cash flows on specified date, and the contractual cash flows are solely payments of principal and interest on the principal amount outstanding. These financial assets are presented as part of the non-current assets unless they are due within 12 months from the reporting date. It is initially measured at fair value including transaction costs. Now let us solve some problems to further understand this topic. For the first problem, on January 1, 2021, Pampanga Company purchased 1 million bonds at 98. The bonds mature on January 1, 2025 and pay 12% annual interest beginning January 1, 2022. Commission paid on the acquisition amounted to 50,000 and the bonds are to be appropriately classified as financial asset at amortized cost. So the requirement is to prepare the journal entry on the acquisition. To solve for this, we will just simply multiply the face value again with the quoted price, which is 980,000, and directly add the included transaction cost. Then we will get 1,030,000. For the journal entries, we will debit investment in bonds and credit cash at 1,030,000. The next topic is term bonds. These are bonds that mature on a single date. To compute for the purchase price or present value of the term bond acquired on the interest rate, we will just add the present value of the principal with the present value of the interest rate. So let us look at this example to get an idea of the concept. On January 1, 2021, Tarlac Company acquired 12% bonds in the amount of 2 million to be appropriately classified as financial asset at amortized cost. The bonds mature on December 31, 2024, and the bonds were acquired to yield 10%, and interest is payable every December 31. So compute for the purchase price of the bond. To compute for the purchase price of the bonds, we will first compute the present value of 1 for 4 periods since the bonds were issued on 2021 and matures on 2024. So there are 4 years. Using your basic calculator, enter 1 plus the effective interest rate, which is 10% or 0.10, and then press the divide button twice and the equal button 4 times since we are computing for 4 periods. Now we have the present value of 1, which is 0.6830. In computing the present value of ordinary annuity, after getting the present value of 1, subtract the answer by 1 and divide it by the interest rate and then multiply it by 100. Now you have the PV of ordinary annuity. Let us now multiply the present value of 1 with the principal, which is 2 million. That is equal to 1,366,000. Next is to compute the present value of the interest using the PV of ordinary annuity multiplied by the principal and the nominal rate, which is 12%. Then the result is equal to 760,776. Now let us add these two together and we can get the purchase price of the bonds at premium, which is 2,126,776. So it is at premium since the investor acquired the bonds for a much higher price. And then for computing the purchase price of the bonds at discount, we can use the same steps from the previous problem. For discounts, the investor bought the bonds for a lower price than its fair value. So on January 1, 2021, again, Zambales Company acquired 10% bonds in the face amount of 2 million to be appropriately classified as financial asset at amortized cost. The bonds mature on December 31, 2024, and the bonds were acquired to yield 12%, and interest is payable every December 31. So again, let us compute for the purchase price of the bonds. To get this, we will first again compute for the present value of the principal using the present value of 1, that is 0.6355, and multiply it with the principal amount of 2 million. Then we can get 1,217,000. And for the present value of the interest, we will use the PV of ordinary annuity, which is 3.0373 multiplied by the principal and the nominal interest rate of 10%, which is equal to 607,460. Now we can add these two together and we can get our purchase price of the bond at discount, which is 1,878,460. Now, when interest is payable semi-annually, we will just simply multiply the number of periods by 2 since there are 2 payments in a year and divide the effective interest rate by 2. Let us look at this example. On January 1, 2021, Zambales Company acquired 12% bonds in the face amount of 2 million. They mature on December 31, 2024. The bonds were acquired to yield 10% and interest is payable every June 30 and December 31. So, interest is payable again semi-annually June and December 31. So to compute for the present value, we will have to use 8 periods. And for the effective interest rate, we will have to divide it by 2. 10 divided by 2 is 5%. So now our effective interest rate is 5%. Then we will use the steps in computing for the present value of 1 and multiply it with the principal. Then we will get the present value of the principal, which is 1,353,600. And for the present value of the interest, using the PV of ordinary annuity, multiplied by the principal and the 5% nominal rate, which is 775,584. Then add the two together, then we will get the present value of the investment bonds when interest is payable semi-annually. Now, how do we compute the purchase price when bonds are acquired in between interest dates? Now, let us look at this illustration to know how these are solved. April 1, 2021, again on April 1, Laguna Company acquired 12% bonds with a face amount of 2 million. The bonds are dated January 1, 2021 and will mature on December 31, 2024. The bonds were acquired to yield 10% and interest is payable every December 31. So compute for the purchase price of the bonds. It is said here that the bond is acquired on April 1, 2021. And to compute for the purchase price, first, we will have to compute for the present value of the bonds on the latest interest date. So since the bonds are dated January 1, 2021, we will compute the present value based on this period. Using the same steps as computing for the purchase price, the present value of the principal would be 1,366,000, which is computed by multiplying the principal of 2 million with a PV of 1, which is 0.6830. Then we will compute for the PV of interest, which is 760,776. Now, the present value as of January 1, 2021 is 2,126,776. Next is to get the present value at the date of acquisition. We will compute for this by deducting the bond premium, which is computed by multiplying the principal by the nominal rate and divide it by 12. Then multiply by 3 for 3 months, January to March. The answer would be 60,000. And the interest rate, which is computed by using the present value of January, which is 2,126,776, multiplied by the effective interest rate of 10%, and then divided by 12 months, and then again multiply by 3. Then we will get 53,169. We will have to deduct the nominal interest rate that we have just computed with the effective interest rate since it is at premium. But when it is at discount, then we will add the two. So after deducting, we will get 6,831 in premium amortization, which is then deducted to the present value in January. Now we have the present value at acquisition date or April, which is 2,119,945. And to get the total purchase price, the nominal interest rate from the last interest date until the date of acquisition, which is 60,000, is added to the present value from the date of acquisition, which is 2,119,945. Now we have the total purchase price of the bonds, that is 2,179,945. And now let us move on to computations for serial bonds. On January 1, 2021, Batangas Company acquired 12% bonds in the face amount of 2 million. They mature on December 31, 2024, and the bonds were acquired to yield 10%. The bonds mature in 4 equal annual installments of 500,000 every December 31, and interest is payable every December 31. Serial bonds are bonds that have a series of maturity dates, hence the 4 equal installments. For us to compute the purchase price, we first have to amortize the bond to its present value. To get the principal, since it is in equal installments, we just have to simply divide the principal of 2 million with the number of periods, which is 4 years. So now we have a principal of 500,000 per year. And for the interest collection, we will just simply divide the principal of 500,000 with a nominal interest rate of 12%, which is equal to 60,000, and multiply it by 4 for the first year. So we have 240,000. Then add the principal with the interest collection, then we can get a total collection of 740,000. And after that, we will compute for the present value factor using the effective interest rate of 10%. So here we have 0.9091. And to get the total present value for year 1, we will just simply multiply the total collection of 740,000 with the present value factor, which is then equal to 672,734. Then we will apply the same steps for the subsequent periods. And to get the purchase price, we will just simply add the total present value for all periods, which is then equal to 2,082,972. Now let's move on to the next topic, which is bonds with warrants. When an investment in bonds is acquired together with warrants, the company should use the relative fair value to allocate the acquisition cost. Now let us have this illustration to further explain the topic. On January 1, 2021, Rizal Company acquired 10% 1,000 investment in bonds with warrants at a cost of 1,100,000. The face value per bond is 1,000, and each bond is accompanied by a warrant that permits the bondholder to purchase 20 shares of common stock at 50 pesos and at 55 per share. The nominal rate is payable annually on December 31. The bonds mature on January 1, 2026. When the bonds were issued, the prevailing market rate of the interest for similar bonds without warrants is 98% per annum, while the fair value per warrant is 20. The account to be debited is investment in bonds of 1,078,000, which is computed as 1,100,000 divided by 100, then multiplied by 98 as shown in the table, and stock rights of 22,000, the same process of computation as the previous account, then credit cash for 1,100,000, which represents the cost. So these are the following journal entries for the acquisition of investment for bonds in warrants. Now let us move on to the subsequent measurement of financial assets at amortized cost. Investment bonds classified as financial asset at amortized cost is measured at amortized cost using the effective interest method, and unrealized gain or loss due to change in fair value is then ignored, where amortized cost is the amount at which the financial asset or financial liability is measured at initial recognition, minus principal repayments, plus or minus the cumulative amortization using the effective interest method of any difference between that initial amount and the maturity amount, and for financial assets adjusted for any loss allowance. So now let us have this example. On January 1, 2021, Quezon Company acquired 12% bonds in the face amount of 2 million at a cost of 2,126,776. They mature on December 31, 2024, and the bonds were acquired to yield 10%, and interest is payable every December 31. So the requirements are to compute for the interest income carrying amount of the investment in bonds, current portion of the bonds and non-current portion of the bonds at December 31, 2021, and to prepare for all the necessary entries during the year 2021. First, let us have the amortization table, where the interest collection is computed by multiplying the face value of 2 million with a nominal rate of 12%. Now we have 240,000. For the interest income for the first year, it will be computed by multiplying the beginning balance or present value, which is 2,126,776, by the effective interest rate of 12%. So now we have 212,678 for interest income. Next, we will subtract the interest collection to the interest income to get the premium amortization, that is 27,322. Then to get the present value for the first year, we will just have to subtract the beginning balance of 2,126,776 to the premium amortization of 27,322. Then we can have the present value for December 31, 2021, which is 2,099,454, and then repeat this process throughout the whole period. So as per requirement, the interest income for 2021 is 212,678. The carrying amount of investment in bonds for December 31, 2021 is 2,099,454. And there is no current portion amount since the entire amount of 2,099,454 is presented as part of the non-current asset, since the principal amount is collectible beyond 1 year. And for the non-current portion of the investment in bonds for December 31, 2021 is equal to 2,099,454. For the journal entries, for January 1, 2021, we will have to debit investment in bonds and credit cash at 2,126,776. And for December 31, 2021, we will have to debit cash and credit interest income at 240,000 and debit interest income and credit investment in bonds at 27,322. For the financial statement presentation for 2021, in the statement of financial position, it is presented as investment in bonds at 2,099,454, and for the statement of comprehensive income, it is interest income at 212,678. Now for the amortization of serial bonds, let us look at this example. On January 1, 2021, Camarines Norte Company purchased bonds with face value of 3 million at a cost of 3,102,568. Then the stated interest of the bond is 12%. Interest and principal are payable annually every December 31, and the bonds are to be held with a 10% effective yield. The bonds mature at annual installment of 1 million every December 31. The requirement is the same as the previous problem to compute for the interest income carrying amount, current portion and non-current portion of the bonds at for 2021 and the necessary journal entries for the year 2021. For serial bonds, we will just have to follow the same steps for the amortization of term bonds. However, for computing the present value, we will have to subtract the beginning present value with the amortization and the principal collection. Hence, 3,102,568 minus 1 million minus 49,743 is 2,052,825, which is the present value for the first year or for December 31, 2021, and so on. So, as per requirement, the interest income for 2021 is 310,257. The carrying amount of investment in bonds for December 31, 2021 is 2,052,825 based on our amortization table, and the current portion of the investment in bonds is 1,034,718 again based on the amortization table, and the non-current portion of the investment in bonds for December 31, 2021 is 1,018,107. So the journal entries are as follows. For January 1, 2021, we have to debit investment in bonds and credit cash for 3,102,568. For December 31, 2021, we will have to debit cash and credit interest income at 310,257 and investment in bonds at 49,743. So we have cash that is equal to 360,000. And then to credit cash and debit investment in bonds at 1 million. For the financial statement presentation for 2021 for financial position, in the current portion, it is presented as investment in bonds at 1,034,718. And for the non-current portion, investment in bonds at 1,018,107. For the statement of comprehensive income, it is presented as interest income at 310,257. For the sale of term bonds on January 1, 2021, Masbate Company acquired 12% bonds in the face amount of 2 million at a cost of 2,126,776. They mature on December 31, 2024, and the bonds were acquired to yield 10%. Interest is payable every December 31, and on December 31, 2022, after receiving the interest, one half of the bonds were sold for 1,500,000. So let us prepare the journal entry to record the sale. First, we will have to amortize the bond up to the date that it is sold. So here we have the present value up to the date of sale, which is 2,069,399. Next, we have to deduct the amortized cost of 1,034,700, which is computed by multiplying the present value for the year 2022 by one half, as only half of the bonds were sold, to the net price of 1,500,000. So the result is the realized gain of 465,300. And the journal entry are as follows. So we have to credit cash for 1,500,000 for the cost and debit investment in bonds for 1,034,700 and the gain on sale for 465,300. For the recognition of term bonds, let us have a look at this example. On January 1, 2021, Catanduanes Company purchased 5-year bonds with a face value of 4 million and stated interest of 10% per year, payable semi-annually on June and December 31. The bonds were acquired for 4,324,400. The objective of Catanduanes' business model is to hold the investment until maturity and to collect the contractual cash flows or principal and interest. On February 28, 2023, the bonds were sold at 105, including the accrued interest. So first, let us amortize the bond up to the date of the recognition. So now we have the present value for February 28, 2023 at 4,178,029. And to compute for the carrying amount of the financial asset at the date of recognition, which will be computed by subtracting the carrying value of the bond for the year 2022, since the bonds were sold in the subsequent year, which is 4,209,644 to the premium amortization of 10,538, computed as 31,614 the premium amortization for the year the bond was sold, and multiply by 2 divided by 6. So the result is the carrying value as of February 28, 2023 at 4,190,106. To compute for the gain on loss on the recognition of the financial asset at amortized cost, we must first compute for the total consideration, which is the face value of 4 million multiplied by the quoted price of 105 or 1.5%, that is 4,200,000 less the accrued interest of 66,667, which is computed as face value of 4 million multiplied by 10% effective interest rate and multiplied by 2 divided by 12. So the result would be the net selling price of 4,133,333. Then we have to deduct it to the carrying value for February 2023, which is 4,199,106. And the result is the loss on the recognition at 65,773. Then the journal entries are as follows. For February 28, 2023, to record separately the receipt of interest and amortization of premium, we have to credit cash at 66,667 and credit investment in bonds at 10,538 and interest income at 56,129. And the journal entry to rec- and the journal entry to record the recognition of the financial asset is to debit cash for 4,133,333 and to credit loss under recognition at 65,773 and investment in bonds at 4,199,106. Alternatively, the compound journal entry to record the receipt of interest, premium amortization, and the recognition of financial asset would be as follows: is to debit cash for 4,200,000 and loss under recognition at 65,773, and to credit investment in bonds, which is 4,209,644, and interest income, which is 56,129. So that is all for the financial asset at fair value through profit or loss and financial asset at amortized cost.
Good day, everyone. My name is Jaojao, and I am going to continue to discuss the topics about the investment in debt securities. So without further ado, let's start now.
These are the following topics to be discussed. We have here the financial asset at fair value through other comprehensive income, the reclassification gain or loss versus reclassification adjustment, the impairment, expected credit loss, ECL model approaches, the impairment flow chart, impairment gain or loss, and lastly, the impairment loss, the fair value through other comprehensive income, and the financial asset at amortized cost. Now let's proceed to the first topic. We have there the financial asset at fair value through other comprehensive income. We are going to tackle the initial measurement, the subsequent measurement, and the computation of unrealized gain or loss. So the computation of interest income and the recognition of fair value through other comprehensive income. For the first topic, we have there the financial asset at fair value through other comprehensive income initial measurement. So for the illustration, we have here that on January 1, 2021, Sampaloc Company purchased 5-year bonds with face value of 4 million and stated interest of 10% per year payable semi-annually June 30 and December 31. The bonds were acquired for 105. Commission paid on the acquisition amounted to 124,400. The objective of Sampaloc business model is to collect the contractual cash flows and sell financial asset. So the requirement is prepare journal entry on the acquisition. In this particular journal entry, we simply debit investment in bonds through fair value through other comprehensive income, 4,324,400, and credit cash, 4,324,400. Now to get the 4,324,400, we have to multiply 4 million times 105% plus the 124,400. For the subsequent measurement of fair value through other comprehensive income, so the subsequent to initial recognition, investment in bonds classified as fair value through other comprehensive income is measured at fair value. However, the amortized cost of the investment will still be computing using effective interest method. The difference between the fair value and the amortized cost is the cumulative amount presented in equity. So, journal entries to record the amortization of premium or discount and computation of interest income are actually the same under the financial asset through amortized cost and the fair value through other comprehensive income. The only difference is the recognition of changes in fair value under the fair value through other comprehensive income. So here we have the illustration. So on January 1, 2021, Sulacan Company purchased 5-year bonds with face value of 6 million and stated interest of 10% per year payable every December 31. The bonds were acquired for 105. Commission paid on the acquisition amounted to 179,125. After considering the transaction cost, the effective rate of the bond on initial recognition is computed to be 8%. The objectives of Sulucan business model is to collect the contractual cash flows and sell financial assets. So we have here the fair value of the investment for the next 5 years as it follows. So not the illustration here. So the question is, there is no indication that the investment credit risk increased from initial recognition. So required compute for the following and prepare the journal entries for the year 2021 through 2025. The interest income, the carrying value, unrealized gain loss equity, unrealized gain loss through other comprehensive income. So in this particular problem, we have first to compute for the initial carrying amount. So for the carrying amount, we have there the acquisition cost, which is 6 million times 1.05, which is equal to 6,300,000. And we have to add the transaction cost, which is the 179,125, so that our initial carrying amount is 6,479,125 pesos. Now, using the initial carrying amount, the amortization table is prepared as follows. So this is the amortization table now. And we already discussed this now in our previous accounting lesson in the intermediate accounting. The next procedure is to compute for the unrealized gain or loss. Now for the recognition, the realized gain or loss, the recognition of financial asset at fair value through other comprehensive income should be recognized in the profit or loss. However, cumulative gains or losses previously recognized in other comprehensive income are reclassified to profit or loss as provided under PFRS 9, paragraph B5.7.1a. For our problem, we have here the illustration. So on January 1, 2021, Balik Company purchased 5-year bonds with face value of 8 million and stated interest of 10% per year payable every December 31. The bonds were acquired at 8,311,172 to yield rate of 9%. The objective of Balik's business model is to collect the contractual cash flows and sell financial asset. So the fair value of the investment for the year ended 2021 and 2022 is 104 and 105 respectively. And the investment was sold for 102 on January 1, 2023, and the company incurred transaction cost amounting to 99,000. So there is no indication that the investment credit risk increased from initial recognition. So for the requirements, we have here prepare the amortization table, compute for the unrealized gain or loss presented as part of the other comprehensive income and inequity. Compute for the recognition, gain or loss to be presented in the profit or loss. Compute for the amount of reclassification adjustment and prepare the journal entry from January 1, 2021 through January 1, 2023. Now for the first requirements, we have to prepare the amortization table. So, kay ba naman tayo, we all know how to compute for or how to make this amortization table. Now, the below is the amortization table. We have the interest collection, the interest income, the premium amortization, and the present value. Now, to get the interest collection, we have to multiply 8 million times the stated interest, which is 10% per year, and this is payable every December 31. And to get the interest income, we have to multiply the present value, which is 8,311,172 times the yield rate, which is the 9%. And after computing for the amortization table, we can now proceed to the requirement number 2, which is to compute for the unrealized gain or loss as follows. So below is the table on how to get the unrealized gain or loss. For the third requirement, we have to compute for the consideration received, which is 8 million times 1.02. That is equal to 8,160,000, and then we have to less the interest income of the investment sold and at the transaction cost, which is 99,000. Now, so that we would be able to get the net selling price, which is the 8,061,000. And after that, we are going to add the unrealized gain, that is through other comprehensive income, which is 197,497. And then we have to deduct the carrying amount, which is the fair value, the previous B and state, which is 8,400,000. And that will be able to get the realized loss through profit or loss, the negative 141,503. For the fourth requirements, this is simply the amount to be presented as reclassification adjustment is equal to the cumulative gain amounting to 197,497, which is recognized in equity. So the 197,497 is included in the realized gain recognized in the profit or loss. For the last requirements, the journal entries. So here are the following journal entries. For January 1, 2021, we have to debit investment in bonds through fair value through other comprehensive income, 8,311,172, and credit cash, 8,311,172. And for the December 31, 2021, we have to debit cash, the 800,000, and then credit interest income, 748,005. And also to credit the investment in bonds through fair value through other comprehensive income, which is 51,995. And also we have to debit the investment in bonds fair value through other comprehensive income, which is equal to 60,823, and to credit the unrealized gain through other comprehensive income, which is the 60,823. Now for the December 31, 2022, for the following year, we have to debit the cash still, 800,000, and then to credit interest income, which is 743,326, and credit investment in bonds fair value through other comprehensive income, 56,674. And we have to also debit investment in bonds at fair value through other comprehensive income, 136,674, and credit unrealized gain through other comprehensive income, 136,674. Now for the next year, January 1, 2023, we have to debit cash 8,061,000. This in getting this one, we have to deduct 8,160,000 and 99,000. And we have also to debit unrealized gain through other comprehensive income, 197,497, and debit the recognition of loss through profit or loss at 141,503, and we have to credit investment in bonds fair value through other comprehensive income is equal to 8,400,000. Let's proceed to reclassification. So as discussed in the chapter 15, no, the reclassification is allowed only when there is a change in business model and applicable only for debt securities. So in addition, any reclassification shall be treated prospectively from the date of reclassification. Furthermore, the appropriate reclassification date is the first day of the reporting period following the change in business model that results in an entity classifying financial assets. So our reclassification here, we have the reclassification from fair value through profit or loss to fair value through other comprehensive income. We have also the reclassification from fair value through profit or loss to financial asset at amortized cost. And we have also the reclassification from fair value through other comprehensive income to fair value through profit or loss. And we have also reclassification from fair value through other comprehensive income to financial asset at amortized cost. And we have also the reclassification from financial asset at amortized cost to fair value through profit or loss. And we have also the reclassification from financial asset at amortized cost to fair value through other comprehensive income. Now for the first reclassification, which is the reclassification from fair value through profit or loss to fair value through other comprehensive income. So if an entity reclassifies a financial asset from fair value through profit or loss to fair value through other comprehensive income, there are following shall be made. So the first one is the financial asset continues to be measured at fair value, and the second one, the fair value at reclassification date becomes the new carrying amount, and the third one is a new effective interest rate must be determined based on the fair value at the reclassification date. So the pro forma entry would be debit fair value through other comprehensive income, fair value reclassification date, and then credit fair value through profit or loss, which is the carrying value reclassification date. Next is the reclassification from fair value through profit or loss to financial asset at amortized cost. No. So if an entity reclassifies a financial asset from fair value through profit or loss and to financial asset at amortized cost, the following shall be made. The first one is the fair value of the reclassification date becomes its new gross carrying amount, and the difference between the fair value at reclassification date and face amount is amortized through profit or loss over the remaining term of the financial asset using the effective interest method. And the third one is a new effective interest rate must be determined based on the fair value at reclassification date. So the pro forma entry would be debit financial asset at amortized cost and credit for fair value through profit or loss. Next is the reclassification from fair value through other comprehensive income to fair value through profit or loss. Now, if an entity reclassifies a financial asset from fair value through other comprehensive income to fair value through profit or loss, the following shall be made. The first one is the financial asset continues to be measured at fair value. The second one is the fair value at the reclassification date becomes its new gross carrying amount. The third one is the cumulative gain or loss previously recognized in other comprehensive income is reclassified from equity to profit or loss as a reclassification adjustment. The pro forma entry would be debit fair value through profit or loss and then credit fair value through other comprehensive income, and also we have to debit unrealized gain and then credit reclassification gain, and as well we have to debit reclassification loss through profit or loss and then credit unrealized loss through other comprehensive income. The next reclassification is the reclassification from fair value through other comprehensive income to financial asset at amortized cost. So if an entity reclassifies a financial asset from fair value through other comprehensive income to financial asset at amortized cost, the following shall be made. First one is the financial asset is reclassified at its fair value at the reclassification date, and the second one is the cumulative gain or loss previously recognized in other comprehensive income is removed from the equity and adjusted against the fair value of the financial asset at the reclassification date. And the last one is that the original effective interest rate will be used to amortize the financial asset. The adjustment of cumulative gain or loss previously recognized in other comprehensive income to the fair value of the financial asset at the reclassification date will bring the carrying amount of the financial asset as if it had always been measured at amortized cost. This adjustment affects other comprehensive income but does not affect profit or loss, and therefore is not reclassified a reclassification adjustment. The pro forma entry would be debit financial asset at amortized cost, which is the fair value reclassification date, and then credit fair value through other comprehensive income, the carrying values reclassification date. And also we have to debit financial asset at amortized cost, and then credit unrealized loss through other comprehensive income, and then debit unrealized gain, and then credit financial asset at amortized cost. The next is the reclassification from financial asset at amortized cost to fair value through profit or loss. So if an entity reclassifies a financial asset out of the amortized cost measurement category and into fair value through profit or loss, the following shall be made. First one is the financial asset is measured at fair value at the reclassification date, and the difference between the fair value at the reclassification date and the amortized cost of the financial asset is recognized in profit or loss. So the pro forma entry would be debit fair value through profit or loss, and then credit and also debit reclassification loss, the profit or loss if any, and then credit financial asset at amortized cost, and also credit reclassification gate through profit or loss if there is any. The next reclassification, and probably the last, is the reclassification from financial asset at amortized cost to fair value through other comprehensive income. So if an entity reclassifies a financial asset out of the amortized cost measurement category and into the fair value through other comprehensive income measurement category, the following shall be made. The financial asset is measured at fair value at the reclassification date, and the difference between the fair value at the reclassification date and amortized cost of financial asset is recognized in other comprehensive income. And then the original effective interest rate will be used to amortize the financial asset. The pro forma entry would be debit fair value through other comprehensive income, and then credit financial asset at amortized cost. And also we have to debit unrealized loss through other comprehensive income, and then credit fair value through other comprehensive income, or debit fair value through other comprehensive income and then credit unrealized gain through other comprehensive income. Now let's move on to the reclassification gain or loss versus the reclassification adjustment. Now the reclassification gain or loss is the difference between the fair value at reclassification date and the carrying amount of certain financial assets. Reclassification gain or loss is either recognized in profit or loss or other comprehensive income depending on the asset being reclassified. Now reclassification adjustment is the amount of unrealized gain or loss recognized in equity being recycled to profit or loss when the asset is recognized. So from unrealized gain or loss through other comprehensive income and then recycled to realized loss through profit or loss, realized gain or loss through profit or loss. Next, let us discuss the impairment. This is under PFRS 9. So impairment of financial assets under PFRS 9 uses the expected loss model or the ELM. Expected loss model recognizes impairment even though there is no objective evidence that the asset is impaired. Hence, impairment loss can be recognized as early as initial recognition. So the entity shall recognize a loss allowance for expected credit losses on a financial asset at amortized cost, fair value through other comprehensive income, which is debt, a lease receivable, a contract asset or a loan commitment, and a financial guarantee contract. For other financial asset and non-financial asset, impairment is covered by other applicable standards. So aside from the lease receivable, contract asset, loan commitment, and a financial guarantee contract, so the following table summarizes the financial asset subject to impairment under Philippine Financial Reporting Standards 9. Now let's move forward to the expected credit loss or the ACL. So expected credit losses is the weighted average of credit losses with the respective risk of a default occurring as the weights. So credit loss is the difference between all contractual cash flows that are due to the entity in accordance with the contract and all the cash flows that the entity expect to receive discount at the original effective interest rate or credit adjusted effective interest rate for purchased or originated credit impaired financial assets. So in getting the credit loss, we have to multiply the cash shortfall and the effective interest rate. So the expected credit loss or the ACL is classified as either either the 12 months ECL, which is recognized if the credit risk on the financial instrument has not increased significantly since initial recognition. This is the portion of lifetime ECL that represents the ECL that results from default events on a financial instrument that are possible within the 12 months after the reporting date. Or it can be classified as lifetime ECL. This is recognized if the credit risk on the financial instrument has increased significantly since initial recognition. It is expected credit losses that result from all possible defaults events over the expected life of a financial instrument. So the credit risk is defined under the Philippine Financial Reporting Standard 7 as the risk that one party to a financial instrument will cause a financial loss for the other party by failing to discharge an obligation. And when we say cash flow, shortfall is the difference between contractual cash flow and cash flow that the entity expects to receive. Let's move forward to the next topic, which is the ECL model approaches. So the ECL model requires two approaches depending on the type of asset or credit exposure. So these are summarized as below. So if our type of asset exposure is a trade receivables, contract assets, and lease receivables, our approach is simplified approach. Now, if our type of asset is other assets and exposure, the approach is general approach, the three-stage or three-bucket approach. For the simplified approach, under the paragraph of Philippine Financial Reporting 9, an entity shall always measure the loss allowance at an amount equal to lifetime ECL for the trade receivables or contract assets that do not contain a significant financing component and has a term of 1 year or less. This is practical expended under PFRS 15 and contains significant financing component but uses lifetime ECL as an accounting policy choice. And for the second one is lease receivables that result from transactions that are within the scope of PFRS 16 but uses lifetime ECL as an accounting policy choice. For the general approach is based on three stages which are intended to reflect the credit deterioration and improvements of financial instrument. An overview of this three-stage or three-bucket approach is shown below. So we have there is the trigger, which is the stage 1 initial recognition, and then the stage 2 is credit risk significantly increased, and then the stage 3 is credit impairment. So for the ECL, we have 12 months ECL and then lifetime ECL, and then for the stage 3, we have lifetime ECL. And for the interest revenue based on stage 1 is the gross carrying amount, and then the stage 2 is gross carrying amount, and the third stage is the net carrying amount. Next is the impairment flow chart. So below is the impairment flow chart, and this is recognized 12 months expected credit loss. For estimating cash flows, an entity shall estimate cash flows by considering all contractual terms of the financial instruments. For example, we have prepayments, extension, call, and similar options through the expected life of that financial instrument. The cash flows that are considered shall include cash flows from the sale of collateral held or other credit enhancements that are integral to the contractual term. Now let's move forward to impairment gain, where this example is reversal and a loss. So in accordance with the paragraph 5.5.8 of Philippine Financial Reporting Standards 9, an entity shall recognize in profit or loss as an impairment gain or loss the amount of ECL or reversal that is required to adjust the loss allowance at the reporting date. So the amount of the gain or loss is computed as follows. So we have there the carrying amount, and then we have to deduct the PV of estimated future cash flows discounted at the financial assets original EIR at initial recognition, so that we would be able to get the impairment loss or gain through profit or loss. Now let's move forward to the impairment loss, which is the fair value through other comprehensive income versus financial asset at amortized cost. So the only journal entries to record the impairment loss of fair value through other comprehensive income in financial asset at amortized cost is as follows. Now for the fair value through other comprehensive income, we have to debit impairment loss. This is property loss, and then credit loss allowances in other comprehensive income. Now for the financial asset at amortized cost, we have to debit impairment loss, profit or loss, and then credit loss allowance in SFP. And as provided under PFRS 9, loss allowance of financial asset at fair value through other comprehensive income shall be recognized in other comprehensive income and shall not reduce the carrying amount of the financial asset in the statement of financial position. So for the financial statement presentation, for FS presentation purposes, the following should be observed. Now for the statement of financial position, we have there the fair value through other comprehensive income, which is PV, gross carrying amount, and then for the financial asset at amortized cost, we have there the gross carrying amount, which is you have to deduct the less allowance in statement of financial position to get the amortized cost or carrying amount below. And for the statement of comprehensive income, which is the impairment loss, Less loss allowances are the profit or loss, impairment loss, and then other comprehensive income. And that would be all, and thank you for listening.
Good day everyone, I'm Jenalyn Lutchavez and I'm the first reporter of Chapter 17, Investment in Associate. An associate is an entity over which the investor has significant influence. Significant influence is the power to participate in the financial and operating policy decisions of the investee, but is not control or joint control of those policies. The existence of significant influence by an investor is usually evidenced in one or more of the following ways. A. Representation on the board of directors or equivalent governing body of the investee. B. Participation in policymaking processes, including participation in decisions about dividends or other distributions. C. Material transaction between the investor and investee. D. Interchange of managerial personnel, or E. Provision of essential technical information. Under PAS 28, investment in associate and joint venture, an investment in associate and joint venture should be accounted for under equity method. PFRS 11 joint arrangement should be used in identifying whether there is a joint arrangement and in classifying whether a joint arrangement is a joint venture. Under PAS 27, separate. Here's an illustration about Raven Pharmaceutical. For the solution, acquisition cost 68 million pesos minus book value of net assets acquired 192 million times 25%, 48 million pesos. Excess of cost over book value 20 million pesos minus the undervaluation of depreciable asset 32 million times 25%, which is 8 million, with a goodwill of 12 million pesos. Number 1. Prepare all appropriate journal entries related to the investment during 2021. On January 2, investment in associate and cash 68 million. August 25, cash and investment in associate 6 million. December 31, investment in associate and investment income 10 million pesos. And on December 31, investment income and investment in associate 1 million pesos. For requirement number 2A, compute for the investment income for the year 2021. Associate net income 40 million pesos multiplied by percentage share, which is 25%. Share in net income before amortization 10 million minus amortization of excess 1 million. Investment income or equity in earnings associate 9 million pesos. As an alternative, the adjusted net income can be adjusted first before multiplying the share as follows. Associate net income 40 million pesos minus amortization of excess 4 million pesos. Adjusted net income 36 million multiplied by percentage share, which is 25%. Investment income or equity in earnings associates, which is 9 million pesos. The requirement number 2B, compute for the carrying amount of the investment on December 31, 2021. Acquisition cost 68 million pesos plus share in net income before amortization 10 million minus amortization of excess 1 million minus dividend received 6 million. Investment in associate during December 31, 2021, which is 71 million pesos. As an alternative, the carrying amount can be computed by using the adjusted investment income as follows. Acquisition cost 68 million pesos plus investment income 9 million minus dividend received 6 million. Investment in associate 71 million pesos. Also, here's an illustration of Blade Company. For the solution of the Blade Company, acquisition cost 2 million pesos minus book value of net assets acquired, which is 1,500,000 pesos, with excess of 500,000 pesos for undervaluation of tangible asset, minus the undervaluation of inventory, which is 50,000, equipment 125,000, land 125,000, with a total of 300,000 pesos. Then, undervaluation of tangible asset minus the undervaluation of inventory, equipment, and land, with a total goodwill of 200,000 pesos. For the requirement number 1, what amount should Blade record as investment income for the year ended December 31, 2021? Associate net income 1,400,000 pesos multiplied by percentage share, which is 25%. Share in net income before amortization 350,000 pesos. 350,000 pesos minus amortization of undervalued inventory and amortization of undervalued equipment, with a total of 275,000 for the investment income or equity in earnings of associate. As an alternative, the adjusted net income can be computed first before multiplying the entity's share as follows. Associate net income, 1,400,000 pesos minus the amortization of undervalued inventory and amortization of undervalued equipment, with the total of adjusted net income, 1,100,000 pesos multiplied by the percentage share, which is 25%, with a total of investment income, equity in earnings of associate, 275,000 pesos. For requirement number 2, what amount should Blade report as investment in associates for the year ended December 31, 2021? Acquisition cost 2 million pesos plus share in net income after amortization 275,000 pesos minus the dividend received 100,000 pesos, with a total amount of 2,175,000 pesos investment in associate for December 31, 2021. Requirement number 3, what amount should Blade record as investment income for the year ended December 31, 2022? Associate net income, 1,600,000 pesos multiplied percentage share, which is 25%. Share in net income before amortization, 400,000 pesos minus the amortization of undervalued equipment and amortization of undervalued land, with a total of 250,000 pesos for investment income or equity in earnings associate. Requirement number 4, what amount should Blade report as investment in associate for the year ended December 31, 2022? Beginning balance on January 1, 2022, 2,175,000 pesos plus the investment income, 250,000 pesos minus the dividend received, which is 125,000 pesos, with a total of 2,300,000 pesos for the investment associate on December 31, 2022. Associate having outstanding preference shares. If an associate has outstanding preference shares that are held by parties other than the investor and classified as equity, the investor computes its share of profits or losses after adjusting for the dividends as follows. Cumulative, fixed rate times total par value of outstanding preference shares for only 1 year, declared or not. For the cumulative, actual dividends declared, that is, deducted only when declared. Redeemable preference share. Redeemable preference shares are counted as financial dividends declared shall be accounted liability, thus as finance cost in the SEI. Therefore, the preference dividends shall no longer be deducted from the net income of the associate because such were already deducted as an expense, that is finance cost, in computing for the net income during the period. For case number 1, assuming the cumulative preference share is accounted as equity by Nuesca and that Nuesca declared dividends of 300,000 pesos on the preference shares, answer the following. 1. What amount should Jenalyn record as investment income for the year ended December 31, 2021? Number 2. What amount should Jenalyn record as investment in associate for the year ended December 31, 2021? Acquisition cost 4 million pesos minus the book value of the net asset acquired 3 million pesos. Excess attributable to depreciable assets, 1 million pesos. Case number 1. Case number 1, number 1, net income, 1,500,000 pesos minus the preference dividends, 250,000 pesos, with a total of 1,250,000 pesos for net income to ordinary shares, multiplied by the percentage of ownership, which is 20%, share in net income of associate, 250,000 pesos, minus the amortization of undervalued assets, 100,000 pesos, with 150,000 pesos investment income or equity in earnings associate. For case number 1, number 2, acquisition cost 4 million pesos plus investment income 150,000 pesos, with a total amount of 4,150,000 pesos for investment in associate on December 31, 2021. Case number 2, assume instead that the preference shares are non-cumulative preference share accounted as equity by Nuesca and that Nuesca declared dividends of 300,000 pesos on the preference shares. Answer the following. 1. What amount should Jenalyn record as investment income for the year ended December 31, 2021? Number 2. What amount should Jenalyn record as investment in associate for the year ended December 31, 2021? Case number 2, number 1, net income, 1,500,000 pesos minus the actual preference dividends declared, 300,000 pesos. Net income to ordinary shares, 1,200,000 pesos. Multiply the percentage of ownership, which is 20%. with 240,000 pesos share in the net income associate, minus the amortization of undervalued assets, which is 100,000 pesos, with 140,000 pesos investment income or equity in earnings associate. For case number two, acquisition cost 4 million plus the investment income, which is 140,000, with a total of 4,140,000 pesos investment in associate on December 31, 2021. Case number 3, assuming the cumulative preference share is accounted as a financial liability by Nuesca, answer the following. 1. What amount should Jenalyn record as investment income for the year ended December 31, 2021? Number 2. What amount should Jenalyn record as investment in associate for the year ended December 31, 2021? For case number 3, number 1, net income 1,500,000 pesos multiplied by percentage of ownership 20%. Share in the net income of associate, which is 300,000 pesos, minus the amortization of excess 100,000 pesos, with 200,000 pesos investment income equity in earnings associate. Case number 2, acquisition cost 4 million pesos plus investment income 200,000 pesos, with the total amount of 4,200,000 pesos for investment in associate on December 31, 2021. Change from cost to equity method. In accounting for change in ownership of an investment at cost or fair value to equity method, that is step acquisition, the rules to step acquisition or business combination achieved in stages under PFRS 3 should be applied. In a business combination achieved in stages, the acquirer shall remeasure its previously held equity interest in the acquiree at its acquisition date fair value and recognize the resulting gain or loss, if any, in profit and loss or other comprehensive income as appropriate. In prior reporting periods, the acquirer may have recognized changes in the value of its equity interest in the acquiree in other comprehensive income. If so, the amount that was recognized in other comprehensive income shall be recognized on the same basis as would be required if the acquirer had disposed directly of the previously held equity interest. For requirement number 1A, unrealized gain or loss to be included in the other comprehensive income as of December 31, 2019. B. Income from investment in gene company to be recognized in 2020 profit or loss. C. Adjustment to retained earnings as of January 2, 2021 as a result of the acquisition of the additional 20% interest in gene company. D. Income from investment in gene company to be recognized in 2021 profit or loss. E. Carrying amount of the investment in gene company as of December 31, 2021. For requirement number 1A, fair value, December 31, 2019, 3,200,000 pesos minus the acquisition cost, which is 3 million. Unrealized gain, other comprehensive income, 200,000 pesos. Requirement number 1B, income from investment in 2020 equals dividend income, 250,000 pesos. Requirement number 1C, fair value, January 2, 2021, 2,800,000 pesos minus the carrying amount of fair value, December 31, 2020, which is 3,100,000 pesos. With the loss on remeasurement, other comprehensive income, 300,000 pesos. Requirement 1D, share of profit for 2021, 4,500,000 pesos minus the amortization of excess, 112,500 pesos, with the investment income of 4,387,500 pesos. Fair value of investment, January 2, 2021, 2,800,000 pesos. Acquisition cost 2021, 5,600,000 pesos, with a total cost of 8,400,000 pesos, minus the carrying amount of net assets acquired on January 2, 2021, 7,500,000 pesos, with 900,000 pesos excess attributable to depreciable assets. Amortization of excess, 112,500. Requirement 1E, total cost, 8,400. Investment income on 2021, 4,387,500. Dividends received in 2021, 900,000 pesos. Carrying amount on December 31, 2021, 11,887,500 pesos. For requirement number 2, prepare all appropriate journal entries related to the investment 2019 to 2021. For requirement number 2, the journal entries are on January 1, 2019, financial asset at fair value through other comprehensive income, 3 million, credit cash, 3 million. On December 31, 2019, debit financial asset at fair value through other comprehensive income, 200,000 pesos, credit unrealized gain, other comprehensive income, 200,000. On December 31, 2020, debit unrealized gain, other comprehensive income, 100,000, credit financial asset at fair value through other comprehensive income, 100,000. On January 2, 2021, debit investment in associate, 2,800,000. Loss on remeasurement, other comprehensive income, 300,000. Credit, financial asset at fair value through other comprehensive income, 3,100,000 pesos. Debit unrealized gain, other comprehensive income, 100,000 pesos. Credit, retained earnings, 100,000 pesos. To close the unrealized gain to the retained earnings. Debit retained earnings, 300,000. Credit loss on remeasurement, other comprehensive income, 300,000. To close the loss on remeasurement retained earnings. On January 2, 2021, debit investment in associate, 5,600,000. Credit cash, 5,600,000. On December 31, 2021, debit investment in associate, 4,500,000. Credit investment income, 4,500,000. Debit investment income, 112,500. Credit investment in associate, 112,500 to record amortization of excess. Discontinuance of equity method, change from equity. According to PAS 28, Part 22, an entity shall discontinue the use of the equity method from the date when its investment ceases to be an associate or a joint venture as follows. A. If the investment becomes a subsidiary, the entity shall account for its investment in accordance with PFRS 3, Business Combinations, and PFRS 10, Consolidated Financial Statements. B. If the retained interest in the former associate or joint venture is a financial asset, the entity shall measure the retained interest at fair value. The fair value of the retained interest shall be regarded as its fair value on initial recognition as a financial asset in accordance with PFRS 9. The entity shall recognize in profit and loss any differences between the fair value of any retained interest and any proceeds from disposing apart interest in the associate or joint venture and the carrying amount of the investment at the date the equity method was discontinued. For the discontinuance of equity method, here's the illustration of James Company. For the solution, acquisition cost 30 million pesos minus book value of net assets acquired 6 million with a total excess of cost over book value 4 million pesos. Undervaluation of land 2 million pesos, building 2 million pesos, and the total undervaluation of 4 million pesos. Goodwill 0. For the requirement number 1, compute for the following. A. Investment balance on December 31, 2020. Acquisition cost January 1, 2020, 30 million pesos, plus investment income, 29,800,000 pesos, plus share in other comprehensive income, 4 million pesos, minus dividend received, 6 million pesos, with a total of investment in associate December 31, 2020, 57,800,000 pesos. Associate net income, 150 million pesos, multiplied by the percentage share, which is 20%. Share in net income before amortization, 30 million pesos, minus amortization of undervalued building, 200,000 pesos, and with a total of 28 million pesos for investment income, equity in earnings associate. Requirement number 1, letter B, compute the total amount that should be recognized in profit or loss on January 2, 2021. Net selling price, 28 million pesos, plus fair value of the retained investment, 28,500,000 pesos, with a total of 56,500,000 pesos, minus the carrying amount of investment, which is 57,800,000 pesos, with a total loss of 1,300,000 pesos. Total ownership interest before the sale, 20%, multiplied by the percentage retained, 1/2, and with the retained interest, 10%. Requirement number 1, letter C, compute gain on sale of the 100,000 shares on January 2, 2021. Net selling price, 28 million pesos, minus carrying amount of investment sold, 28,900,000 pesos, and with the loss on sale, 900,000 pesos. Requirement number 1, letter E, compute gain on reclassification of remaining 100,000 shares on January 2, 2021. Fair value of the retained investment, 28,500,000, minus the carrying amount of investment sold, 28,900,000 pesos, less reclassification, 400,000 pesos. Requirement number 1, letter E, compute the unrealized gain to be recognized in the December 31, 2021. Fair value of the retained investment, 29 million pesos, minus the initial carrying amount of fair value to other comprehensive income, 28,500,000 pesos, with a total of unrealized gain, other comprehensive income, 500,000 pesos. For the requirement number 2, prepare all appropriate journal entries related to the investment starting January 2, 2021. January 2, 2021, cash 28 million, loss on sale, profit and loss 900,000, investment in associate 28 million 900,000. January 2, 2021, financial asset at fair value through other comprehensive income 28 million 500,000, loss on reclassification 400,000, investment in associate 28 million 900,000, revaluation surplus 4 million pesos, retained earnings 4 million, and December 31, 2021, financial asset at fair value through other comprehensive income 500,000, unrealized gain other comprehensive income 500,000. Here's the second illustration in discontinuance of equity method. For the requirement number 1, compute for the goodwill or gain on acquisition. Consideration transferred 50 million plus 10 million, 60 million. Plus fair value of previous equity held, which is 24 million, plus non-controlling interest 60 million minus 1 million divided by 50% times 30%, which is 35 million 400,000 pesos, with a total of 119 million 400,000 pesos, minus the fair value of identifiable net asset, which is 110 million pesos. Goodwill 9 million 400,000 pesos. For the requirement number 2, prepare all appropriate journal entries related to the investment starting January 2, 2021. Investment in subsidiary 84 million pesos, cash 50 million pesos, land 10 million pesos, investment in associate 20 million pesos, and gain on reclassification 4 million pesos.
Greetings, everyone. Before we proceed further, allow me to introduce myself. I am now Francine Piquero, the last reporter of Group 5. So now, let's continue the chapter 17.
Okay, in illustration on lien disposal, Allison Company held an interest in Lisbon Company. On January 1, 2021, Lisbon issued 50,000 new shares of 2 pesos each to Alicia Company at par. So Lisbon Company has the following data prior to issuance of the new shares. So share capital before its increase was 300,000 pesos at 2 pesos par, and net assets were 400,000 pesos. Required, how should Allison account for the deemed disposal if originally Allison has? So case number 1 is 25% interest in the adjusted balances of the related accounts before deemed disposal are. In an investment in associate account is 100,000 pesos. The cumulative share in the associates gain on exchange difference on translation of foreign operation is 50,000 pesos.
Now, arin natin sa solution. So, in case number 1 is loss of significant influence. So, ang kaning loss of significant influence na nasa procedure, which is the recognized gain or loss from partial disposal in the P&L, and discontinue the equity method. Then reclassify the total share in OCI of associate in P&L or close to retained earnings, and to apply the requirements of PFRS 9. Okay, so before we proceed the solution, deemed disposal is the loss on deemed disposal is recognized in the profit or loss, and it is also known as dilution. Okay, outstanding shares of the investee before deemed disposal at 300,000 pesos. I-divide mo sa 2 pesos equals to 150,000 pesos. And by multiply by old interest yield natay 25%. So ang kaning 25% na nasuggest sa anang problem. Okay? And to come up ng 37,500, imo siyang i-times 150,000 times 25%, that would be 37,500. So, ang kaning 37,500, ano yung imong number of share held before the disposal. Okay? So, by divide by total new shares, outstanding shares of the investee before the disposal will be 150,000 50,000. So, mga gihapon, imo siya gibalik-dibalik sa kailangas pabaw. And also, imo siya i-add sa new shares issued, which is 50,000 pesos. Going back ni siya sa problem, na ni siya 50,000. And then, ang kani siya, imo siya i-plus. So, 150,000 i-plus nimo sa 50,000 equals 200,000. So, ang kaning 200,000, mas dyan i-divide sa 37,500. So, 37,500 i-divide nimo sa 200,000. That will be 0.1875. So, di pa ni siya mauha. So, ato na ni siya i-times sa 100. So, mo na ni 18.75%. So, sakto. Ang kaning 18.75%, mao na ni ang imong the new interest, and is presumed that RO no longer has significant influence. Take note. So, ang kaning siya, that will be our share in the ownership and after deemed disposal. Okay? So, in the loss on deemed disposal is computed as follows. So, the carrying amount of investee's net asset before issuance at 400,000 pesos. And then, the add issue price of new shares issued is 50,000 times 2 pesos equals to 100,000. So, ito na siya i-plus. So, 400,000 plus 100 equals 500,000 pesos. So, ang kaning 500,000, mo na ato new carrying amount, the investee's net asset after issuance. And then, ang kaning 18.75%, mo na siya, it will be by multiply by new percentage, which is 18. Kaning. Bali, ang kaning siya, gikan sa babaw. So, mo na ni ato new percentage. So, to check kung sakto ang iyang answer, so na ganini, 500,000 i-times nimo sa 18.75%. So, 93,750. Check. Sakto. So, mana ni, nasa dyan i-less sa carrying amount before the disposal. That will be 100,000. So, kanin siya, imo siya i-minus. The 93,750 minus 100,000, not time negative 6,250. So, ang kanin siya, that will be our loss on deemed disposal, P&L. Okay, so pertinent journal entries are in 2021. Atong entry is Johannes Jaojao. So, January 1, ang atong debit is loss on deemed disposal, P&L, is 6,250. And ang atong credit is investment in associate, which is 6,250. And also in translation gain of foreign operation, money atong debit with 50,000 pesos. And gain on reclassification and P&L, that would be atong credit 50,000 pesos. Take note that the amount of cumulative translation gain to be recycled to profit or loss is the total cumulative translation gain because significant influence was lost. Okay, so if the investment is reclassified to financial asset at FVTPL and assuming that the fair value of the share is 3 pesos. So in January 1, financial assets at FVTPL is 37,500 times 3 pesos. That would be 112,500 ang atong debit. And investment in associate, 100K minus 6,250 equals to 93,750. That will be our credit. And then gain on reclassification, P&L, 18,750 debit. And the new carrying of FA at FVTPL is 37,500 times 3 pesos equals to 112,500. Then, at the minus sa less carrying amount after the disposal, that will be 93,750. That will be equals to 18,750 pesos. So, money ang kaning 18,750 money ang gain on reclassification in P&L.
In case number 2, 30% interest and the adjusted balances of the related accounts before deemed disposal are investment in associate account is 120,000 pesos before deemed disposal. Then cumulative share in the associates gain on exchange difference on translation of foreign operation is 50,000 pesos.
So, in case number 2, no loss of significant influence. So, ang ganis dyan, ang iyang procedure is recognize sa iyong gihapon sa loss of significant influence that will be recognized gain or loss from partial disposal in the P&L and continue the equity method and reclassify the share in OCI of associate in P&L or close to retained earnings in proportion to the decrease in ownership. And also, it apply the requirements of PAS 28. Ang ganito is the loss on deemed disposal is recognized in the profit or loss. Take note. And money, dahil sila procedure. So, total outstanding shares of the investee before deemed disposal is 300,000 pesos. Dividing mo sa 2 pesos yapon equals 150,000. Then multiply by old interest yield with 30%. Well, answer ni is 150,000 times sa 30%. That will be 45,000 pesos. So 45,000. So ang kaning 45,000, mo na itong number of share held before deemed disposal. So, margihapon, divide by total new shares. Outstanding shares of the investee before deemed disposal is that will be 150,000 and add the new shares issued is 50,000. So, same margihapon, ay mas dyan i-plus. Then, equals to 200,000. 200,000. Add issue price of the new shares issued is 100,000. Balik sa na to? So, 45,000. 45,000. I-divide mo sa 200. That would be 0.225. Then, i-times same also sa case number 1. 100. So, nanatay 22,000. 22.5%. So, 22.5% ni Sidja. So, 22.50%. And also, money ang atong number sa money atong share in the ownership and after the disposal. So, the carrying amount of investees' net asset before issuance is 400,000, and the total new carrying amount the investees net asset after issuance, that will be 500,000 pesos. Kaya i-plus ihapon saying gapon sa case number 1, and by multiply by new percentage which is 22.50%, that will be atong carrying amount after the disposal is 112,500. So, less than just the carrying amount of investees' net asset before the disposal, that will be 120,000. Going back sa problem na ni siya. And, ang atong loss on demand disposal, that will be 112,500 minus sa 120,000, that will be negative 7,500. So, manis siya ang loss on the demand disposal. Okay. So, in pertinent journal entries are, in year 2021, January 1 is debit, loss on gain disposal, so 7,500, and credit investment in associate with 7,500 also. In January 1, translation gain of foreign operation at 12,500. Ano itong debit, and credit is gain on reclassification nga 50,000 times 7.5%. I-divide mo sa 30%, that will be equals to 12,500. Take note that the amount of cumulative translation gain to be recycled to profit or loss is the proportionate decrease. This old interest of 30% minus new interest of 22.50% equal to 7.50%. So I divide by 30% interest and multiplied by the total cumulative translation gain. Manang kanisi siya. Okay?
So the next problem is it's about investment in associate or share in losses. So the reference of this problem is on the book on page 667. Okay. In the problem of impairment losses, if here the Nairobi company acquires a 30% interest of the ordinary shares of Berlin Company on December 31, 2021, before assessment of possible impairment, the investment in associate has a balance of 1,500,000 pesos. The impairment testing yielded the following information: the fair value less cost of disposal the 1,050,000 pesos, and value in use of the investment is 1,100,000 pesos. Required is determine the impairment loss.
So, ang solution, in the year of 2021, the interest in the associate in 2021 before adjustment is computed as follows. Investment in associate with 275 pesos, 275,000 pesos. Investment in preference shares is 1 million pesos. Advances to associate in Judy is 350,000 pesos. Take note, the question nga nawa gi-appeal ang trade receivables, trade payables, kay nana sa notes. Sa notes, nga ang total interest does not include the following. So, na-appeal man ang trade receivables, trade payables, and also any long-term receivables for which adequate collateral exists, such as secured loans. So, ano siya i-appeal di bali sa kanina solusyon. So, ang cut na ang na-appeal na investment in associate, investment in preference shares, and also the advances to associate Judy. So, by total the amount of this entry of this transaction, that will be 1,625,000. So, ang kani siya, manay ang aton total interest in the associate before adjustment sa year 2021. So, in the journal entry in 2021 is as follows. December 31 is, ang debit nato is investment loss associate is 3 million times 30%. That will equals 900,000 pesos. Investment in associate, mana ang atong credit, that will be 275,000 pesos. And ang credit also, investment in preference share or balancing amount, 625,000. Then the interest in the associate in 2021 after adjustment is computed as follows. Investment in associate is 275,000 minus 275,000 equals to 0. And the investment in preference shares, 1 million minus the 625,000. That will be 375,000. And advances to associate in Judy is 350,000 pesos. Then, ang remaining interest in the associate after adjustment will be 725,000 pesos. Okay. And 2022 is the journal entry in 2022 is as follows. In December 31, investment loss associate 2 million times 30%. Mana itong debit is 600,000 pesos. An investment in preference shares, that will be 375,000 pesos. And advances to associate balance amount, that will be 225,000 pesos sa credit. And the interest in the associate in 2022 after adjustment is computed as follows. For first is the investment in associate, pero 0 na siya. An investment in preference share, tayo 375,000 in minus sa 375,000 gihapon, that will be 0. And ang advances to associate in Judy, 150,000 pesos minus 225,000 pesos equals to 125,000 pesos. Atong remaining interest in the associate after adjustment, say 125,000 pesos. Before we proceed sa 2023, kanisya, money the sharing of losses of associate shall be recorded as follows. First, charge to balance of investment in associate. Second is next is charge to balance of investment in preference shares. And lastly, charge to unsecured long-term receivables and loans. So after the investor's interest is reduced, diba sa kani? So after the investor's interest is reduced to 0, so additional losses are provided for and a liability is recognized. So only to the extent that the investor has incurred legal or constructive obligation or made payments on behalf of the associate. So if the associate subsequently reports profits, so the investor assumes recognizing its share of those profits only after its share of the profits equals the share of losses not recognized. Okay. In year 2023, the journal entry is December 31, investment loss associate, manatong debit, is 125,000 pesos. And advances to associate, manatong credit, is 125,000 pesos. So the amount of investment loss associate should be 300,000 pesos. So 1 million times 30%, but the remaining interest in associate is only 125,000 pesos. So hence, the maximum amount that can be recognized is up to 125,000 pesos. Therefore, the investor has an unrecognized loss of 175,000 pesos. If the associate subsequently reports profits, the investor resumes recognizing its share of those profits only after its share of the profits equals the share of losses not recognized. So in 2024, the net income of associate is 2,800,000 pesos. And by multiplied by percentage of ownership, that will be 30%. And the share in the net income associate is 840,000 pesos. And the last unrecognized net loss in 2023 is 300,000 pesos minus the most of 125,000 pesos equals to 175,000 pesos. So adjusted share in the net income, those minus, that would be 665,000 pesos. The journal entry for 2024 would be December 31. Advances to associate is 350,000 pesos, manay atong debit. Investment in preference share or balancing amount is 315,000. Manay atong debit also. And ang credit nato is investment income associate. That will be 665,000 pesos.
Okay. And the problem of impairment losses. If here the Nairobi company acquires a 30% interest of the ordinary shares of Berlin company. On December 31, 2021, before assessment of possible impairment, the investment in associate has a balance of 1,500,000 pesos. The impairment testing yielded the following information: its fair value less cost of disposal will be 1,050,000 pesos, and the value in use of the investment is 1,100,000 pesos. Required is determine the impairment loss.
So, alin na po sa solution. In carrying amount before impairment loss is 1,500,000 pesos. And the last recoverable amount, the higher between fair value less cost of disposal and value in use, is 1,100,000. Impairment loss will be, ito na siya in minus, that will be 400,000 pesos. So the journal entry to recognize the impairment loss is December 31, 2021. Ang atong credit is impairment loss P&L 400,000 pesos. And ang atong credit is investment in associate is 400,000 pesos. Okay?
You have here the illustration of upstream and downstream sale of inventory.
You can read this problem on page 673.
Okay, so here's the solution of sale of inventory. So cost of investment, that will be 1 million pesos. And the last book value of net asset acquired is 3 million times 25%. Nani sila sa problem. Nani sila sa problem, kani. 3 million, that will be the book value of the net asset, and the 25% manigibos ni Raquel's company. So anyways, so 3 million times 25% equals 750,000. So 1 million minus 750,000 equals 250,000 pesos. So kaning 250,000 pesos money ang atong exist attributable to undervalued machine. Next is the requirement number 1, letter A, downstream sale. Yung net income na to, 1 million pesos gihapon, and by multiply percentage of ownership interest with 25%. So same gihapon diri atong gihapon total would be 250,000 pesos. So ang kaning 250,000 pesos man ang atong share in the net income before adjustment. And then ang kaning sadya, it will be less sa adjustment minus unrealized profit on the ending inventory. 20,000. So nabilong ni siya sa kaning gisubay ra na to ni siya sa formula. So ang kaning formula na ni siya sa page 671. Tara. Kani. Mao siya atong gisubay nga formula, and ang kanipod nga problem 70, ang 70,000 minus 50,000 mao siya sa second paragraph sa problem. Okay, so i-times nimo siya sa 100%, that would be 20,000. Then, ang kaning 25,000 also, i-less gyapon siya. So, money ang atong amortization of undervalued machinery. Then, ang kani is 250,000, i-divide din mo sa 10 equals 25,000. 250,000 i-minus sa 20,000, then minus also sa 25,000 equals 205,000 pesos. So, ang kanyang 205,000 pesos, ano yung atong investment income or equity in earnings of associate. And requirement number 1, letter B, downstream sale. Acquisition cost on January 1, 2021, na to 1 million pesos. And i-add na to sila sa investment income with 205,000. And less na to sa dividend received na 100,000 pesos times 25%. That will be equals to 25,000. So, ang add sila. So, 1 million plus 205,000. That will be 1,205,000 minus at 25,000 equals 1,180,000. So, ang kaning siya, money ang atong investment in associate on December 31, 2021. So, ang kaning problem, ang kaning solution na anis siya makita sa basic formula. So, ang kaning basic formula sa yung gihapon na gihapon siya sa 671 apubig kani. So, sa kaning net income times percentage of ownership. Okay? Next is requirement number 2, letter A, upstream sale. Net income will be 1 million pesos, then multiply by percentage of ownership with 25%. So, maghihapon natin share in the net income before adjustment with 250,000 pesos. And the last adjustment, ito sa siyang ilas, sa adjustment minus unrealized profit on the ending inventory. So, 70,000 minus 50,000. I-times nimo sa 25% equals to 5,000. So, i-less na po nimo siya sa amortization of undervalued machinery with 250,000 i-divide sa 10 equals 25,000. So, kani siya, i-less nimo, that will be 220,000. Ito rin siya, i-less. Okay? So, ang kani siya, money ang atong investment income or equity in earnings of associate. Lastly, requirement number 2, letter B, upstream sale. So, acquisition cost with January 1, 2021, 1 million pesos. So, add na to sa investment income, that will be 220,000. And the last nimo sa dividend received, with 100,000 pesos times 25% equals 25,000. So, imo siya i-add and less sa 25,000 equals to 1,195,000. So, ang kani siya is money atong investment in associate on December 31, 2021. Okay? Okay, now, you have here the illustration on upstream and downstream sale of equipment.
So, di na ako sa basahon pa ang problem. So, kung ganahan mo og na ay reference, naara sa page 674.
Okay, so here's the solution on sale of equipment. So, cost of investment, well, that will be 1 million pesos. And less sa book value of net asset required with 3 million times 25% equals 750,000. So 1 million minus 750,000 equals 250,000. So according to 250,000, that will be our excess attributable to undervalued machine. In requirement number 1, letter A, downstream sale, net income is 1 million thousand and multiply by Percentage of ownership interest with 25% equals 250,000 pesos. So, ang kani si Jaman itong share in the net income before adjustment. And ilas sa net minus unrealized gain from downstream sale of PPE. Arita. So, 800,000 pesos minus 600,000 pesos equals 20,000 pesos. Then it times nimo sa 4, that will be 800,000. And then i-minus or i-divide nimo sa 5, that will be 160,000. Then it times nimo sa 100%, that will be 160,000. And lastly mo sa amortization of undervalued machinery is 250,000 i-divide sa 10 equals 25,000. So, i-minus din mo ng 160 o 25,000 sa 250,000. So, equals 65,000 pesos. So, ang kaning 65,000 pesos man yung investment income or equity in earnings of associate. Next is requirement number 1, letter B, downstream sale. Acquisition cost, January 1, 2021, 1 million pesos, and an add investment income, that would be 65,000, and less na to just a dividend received with 100,000 pesos times 25% equals 25,000. So, 1 million i-plus nimo sa 65,000, then i-minus nimo sa 25,000 equals 1,040,000 pesos. On to investment in associate on December 31, 2021. Requirement number 2, letter A, upstream sale. Net income is 1 million pesos and multiplied by percentage of ownership interest with 25%. The same hapon is 250,000 pesos. And atong less is net minus unrealized gain from downstream sale of PPE is 800,000 pesos. 800,000 pesos minus 600,000 pesos. Then i-times na po din mo sa, i-times din mo sa 4, then i-divide sa 5, then times 25% equals 40,000. And less mo sa amortization of undervalued machinery is 250,000. I-divide sa 10 equals 25,000. So, i-less mo ng 40 o 25 sa 250,000. That will be 185,000 pesos. So, money atong investment income or equity in earnings of associate. Last is requirement number 2, letter B, upstream sale. Acquisition cost on January 1, 2021, that will be 1 million pesos. I-add nimo sa investment income with 185,000. And less dividend received is 100,000 pesos. I-times nimo sa 25% equals to 25,000. Then, you must jump, i-add up. So, 1 million i-plus nimo sa 185,000. That will be 1,185,000. And i-minus nimo sa 25,000 equals 1,160,000. And then, honest siya ang atong investment in associate on December 31, 2021. We have here the last problem, which is the comprehensive. On January 1, 2020, our Toro company bought 30% outstanding ordinary shares of Monica Company for 3 million pesos. Their book value was 9 million pesos, and the difference was attributable to the fair value of Monica's buildings exceeding book value. The buildings have a remaining life of 20 years. Monica Company reported the following net income and dividends for 2020 and 2021.
So, dinala na ako sa basahon pa ang problem, which is kaning nasa required sa nasa screen. So, kung ganahan mo o kanang reference nara sa page
676. Okay. So, dari na ta sa solution. Requirement number 1, acquisition cost is 3 million pesos. And less book value of net asset acquired, 9 million pesos times 30%, which is 2,700,000. So, ato sa dyan i-minus equals 300,000 pesos. So, ang kaning 300,000 pesos, man yung atong exist, minus undervaluation of building. So, i-less tapos siya sa undervaluation of building, which is 300,000. So, equal 0 na siya. So, 0 pesos ang atong goodwill. And then, net income of the associate, which is 3 million pesos, and multiply by percentage of ownership, which is 30%. So, 3 million times 30% equals 900,000 pesos. So, ang kaning 900,000 pesos, man natin share in the net income before adjustment. And then, i-less na po sila sa amortization of undervalued building, which is 300,000. 300,000, i-divide na to sa 20, equals 15,000. Okay, so upstream sale. I-add na to ang unrealized loss on sale of land. Loss on sale on land, which is 600,000 pesos minus 500,000 pesos times 30% equals 30,000. Then in-add na to sa net minus unrealized loss on sale of machinery, which is 900,000 pesos minus 600,000 pesos equals 300,000 times 5. Then i-divide sa 6. Then i-times na po nato sa 30% equals 75,000. Okay. So, i-less ng 15,000 sa 900,000. So, ang kaning 30K o 75K, i-add na to. So, equals, i-total ni mo tanan, which is 990,000. So, na ang kaning 990,000 pesos, man yung atong investment income or equity in earnings of associate. So, in requirement number 2, acquisition cost, January 1, 2021, that will be 3 million pesos, and add investment income with 990,000, and less na to sa dividend received, which is 1 million pesos times 30% equals 300,000. So, i-add up, i-total mo na sila tanan, which is 3,690,000 pesos. So, money yung atong investment in associate on December 31, 2021. And requirement number 3, net income of the associate, that will be 4 million pesos. So, ang 4 million, gikan sa year on 2021, darada? Year on 2021 net income. And then, multiplied by percentage ownership, which is 30%, and equals, so 4 million times 30% equals 1,200,000 pesos. So, ang kanis siya man itong share in the net income before adjustment. So, last na to suggest amortization of undervalued building, which is 300,000. Divide by 20 equals 15,000. Then, in upstream sale, realized loss on sale of machinery in 2020, which is 300,000. I-divide na to sa 6, then times 30% equals negative 15,000. Yeah. Then, unrealized profit on sale of inventory, that will be 1.2 million, minus of 1 million, times 60% times 30% equals negative 36,000.
Then ang atong downstream sale is net minus unrealized profit on sale of equipment. That will be 1 million pesos minus 800,000 pesos times 4 i-divide sa 5 equals negative 160,000. So, i-total mo sila, i-total mo sila, ang result is 974,000 pesos. So, ano itong investment income or equity in earnings of associate. And lastly, the requirement number 4, beginning balance on January 1, 2021, that will be 3,690,000 pesos. And the add na to sa investment income, which will be 974,000. Then, i-minus din mo sa dividend received with 1,500,000 times 30% equals 450,000. So, i-total mo sila tanan. That will be 4,214,000 pesos. So, money atong investment in associate on December 31, 2021. Thank you.